Yeah.
Hi, everyone, and welcome to round 6 of the NewDeal Invest live Q&A here on YouTube. Thanks to everyone for tuning in. For the next hour, we sit at the ready to answer any and all questions you may have related to our portfolios, the technology stocks that we follow, or really anything else you think we might find relevant or interesting. Please ask your questions in the YouTube live chat and as we go along, and we will try to get to as many questions today as we possibly can. My name is Jesper Beck. I am a UX designer and and part of the portfolio team here at NewDeal Invest. And today I am joined by Mads Christiansen. Hey Mads, will you just introduce yourself?
Yeah. I'm the founder and CEO of NewDeal Invest. NewDeal Invest, a fund that invests in technology companies. We create broad portfolios, and you can invest with us via eToro platform. We have NDI Future Tech, and we have a Danish public listed fund with the ticker code PMINDI, and then we have a non-listed Danish fund as well. It's called an EIF. That you can invest with. Yeah. So
Yeah. Very good. So just before we get started, a short disclosure. Please note that anything that we may discuss today shouldn't be considered investment advice. We're simply here to have a great time and nerd out on stocks with you guys. So please remember to always invest at your own risk. And Mads, I believe before we get to some questions, you had something you wanted to share just to begin with?
yeah, I just wanted to run over Dell earnings and Salesforce earnings. We had a downswing in the SaaS segment, and I just think it was a very interesting week because of that. We've been very, very cautious on the SaaS companies. They've been so loved by the market, and that's one of the things we use in our process to, if something is really loved both by the street and the market, then we're very cautious about it because it can really go bad then. But let's start with Dell earnings. Dell has been a stock that the market has really liked, and yeah, for good reasons. It's been going up a lot, and a lot of expectations were about the earnings, how much their data center business would grow in the Q1. The data centers for hyperscalers, I think the number one stock you think about is Supermicro Computer, but they can't deliver everything, and Dell is really has a foot in with enterprises. So a lot of expectations that they'll be living at a lot of the AI compute capacity for enterprises. And then Dell also has a tailwind, or an expected tailwind, from the PC market that everybody expects to recover late this year or maybe next year. So a lot of tailwinds possible for Dell. And so expectations were high, and as we see here on the stock price, shares trading down about 20% on the earnings day due to the earnings. And AI capacity really grew, or AI deliverance. They grew that, I think it was 113%, something like that. And AI data center is now 7.5% of the business, so it's growing. What the market didn't like was that the profit margins were declining. And Dell said it was because of product mix. The earnings or the margins on AI capacity is not as big as in the PC market or the traditional enterprise market. So product mix hurt the margins, and then they were also preparing for a build out coming the coming years, both in PC and AI server market. So I think it's interesting, and it will be yeah, I think it will be a good investment from here because of the tailwind that will come. I'm not sure really long term. I think in a couple of years, next couple of years, Dell could be very interesting. But long term, we're a little bit cautious about Dell because they are more a selling organization than, for instance, Supermicro Computer. Supermicro Computer is 50% engineers, and that should give Supermicro Computer an advantage in a more complex future of AI compute over Dell, for instance. But the Dell thesis is that enterprises is going to buy AI compute and have a lot of AI functionalities in on-premise in their data centers. So the alternative to that is to buy cloud services, and cloud services has really been hit hard this quarter here, and a lot of companies have reported or guided weak for the growth in the rest of 2024, and it culminated last week when UiPath came out with a really low guidance. I think they slashed their growth guidance for 24 from something like something in the 20s and then down to a low double digits growth. And Salesforce came out the same day and slashed their guidance for growth to single digit growth, and that will be the first quarter in 2 decades where they only grow single digit. So that's really something. And the big question for investors is this because the enterprises are more focused on building out AI functionality, and is this all these AI functionalities, are they going to replace companies like Salesforce, or what is it? So the SaaS companies, they say it's because of macro that demand is falling, and that's very plausible. Software is cyclical, so it makes sense. So we have to guess on it whether it's going whether demand is coming back to Salesforce, or the demand is more going to go to Dell and Supermicro in the future. Probably it's going to be both, but it'll be very interesting to see. And it's just funny how these bad news sort of accumulate. Here's Snowflake. We see them topping out early this year at around 240, and now it's trading at around 136. Also guiding pretty weak. And Snowflake, a year ago, everybody talked about they had no competition and they were dominating, and now they have Databricks as a competitor, and we have Microsoft with a similar product, and Amazon. So focus sort of shifts and narrative shifts, and these stocks are not darlings anymore. So that creates some interesting opportunities, I think. So very, very interesting times. And in NewDeal Invest, a large part of our strategy is to absorb these fluctuations in share prices and to rebalance our portfolios and thus gain some for one part, some stability in the portfolios, but also really just create value by rebalancing. Yeah.
All right. We had a question come in just prior to going live from Chris, who asked, "What are your thoughts on Intel and ASML in the current build-up and the current build-up of chip fabs in the EU and the USA?"
Yeah, it's a great question, and the short answer is it's really great for Intel, especially trying to catch up with TSMC, that they sort of get some subsidiaries to do that from governments all over the world. They're building in Germany as well under the European Chip Act and in the States. And yeah, so it's naturally good if you're behind and you need to invest a lot. And yeah, they are getting ahead. They are ahead with high NA EUV, where they seem to be getting ahead of TSMC. So and they are doing this 5 nodes in 4 years. Pat Gelsinger is trying to undo the bad decisions that they made when they were late to EUV and stayed too long in deep ultraviolet, and thus lost their technological advantage over TSMC. So it's going to be exciting to see if they can get it back, but it's really, they have to make it work. So there's a lot of execution risk there. But so I think it's pretty good for them. But I think we hope to get Simon He from our portfolio team on next time, and I think we'll let him answer that question. His knowledge about the chip sector and Intel in particular is just extreme. So I think we'll let him talk about Intel, which I think really is one of the very interesting stocks right now, because they are coming from behind and there's a huge execution risk, but they also have a shot at being a really good competitor to TSMC in the future.
Yeah, I think Intel can definitely draw a huge advantage from being so important to the US that they'll always, have someone holding their hand over them, no matter what. So, but we do actually have another Intel-related question, but I think we'll just save that for next time and see if we can get Simon on board and really dive deep into that area.
Yeah.
So we have a question that we skipped last time from Sen, which is about Gravity. If this is a stock that you still like long term, as
yeah, Gravity, for those of you who don't know, it's a South Korean games company. They have they have the license to an IP which is called Ragnarok, which is a cartoon from like 20, 30 years ago, and they've built some quite successful mobile games on this IP, and they're really the games are big in Southeast Asia and China, Japan, and then in Latin America as well. They are owned by a large Japanese games company, and they're earning a lot of money. They're trading at very low PEs, but the problem is that they just stash their money on their balance sheet, and they don't pay dividend, and they don't buy back stocks, and they're not doing any M&A. They're not really doing anything that investors typically want, and that's why the share price is just so low. It's like you own a money tank, but it's closed, and you can't get the money out, so it's not really worth anything. But yeah, and yeah, so I like the stock because it's cheap. I dislike the stock because they are not investor
friendly.
Yeah. And I think one of the things that the market miss is that when you're a games company, you invest a lot in the IP that you build, the games that you build up front, and if the games are not a success, then it's a disaster to run out of money. So it's actually something like gambling theory, that you need to have enough money so that you only invest a certain amount of your money each time in a new game. You need to be able to accommodate a couple of flops in a row.
Yeah.
And I don't think that this is appreciated by investors. I think Gravity has to just hoard money on their balance sheet to be able to to be sure not to go bankrupt in the future because of a couple of flops. So it makes sense, but markets don't understand it, and thus it's cheap. But I like it, and it's a good diversification for our portfolios, and because it's very hard to find good investments in Southeast Asia, and Southeast Asia is probably one of the most attractive regions to be invested in. Young populations and digitization just running at a fast speed, and sort of reliable governments as well. So that's the function that gravity has for us.
Yeah, I think if Gravity, I don't know if it's founder led, but if Gravity management really cares about keeping the company alive long term, I think that conservative approach is probably really healthy, because even though the vast majority of profits in gaming is made in mobile now, it's also only the very little top percent of any kind of mobile games that actually make all the money. So obviously there's going to be flops, even if you're a big player in the market. So
Yes, but you're from the gaming industry. That
yeah,
I can't remember the names, but there's been, I think, a numerous Swedish and Norwegian games companies that just run
yeah.
out of cash. They've been hyped because of this new game that was coming out, and it was a flop, and then they run out of
I
money.
mean,
So
yeah, Embracer Group did this whole consolidation of the basically like a whole lot of the European game development ecosystem, even branching out to board games and other IP, and then the whole thing just failed because of one big AAA title that was supposed to really fuel the next few years being a massive flop. Completely mismanaged that project, and then now the company is splitting up into three different ones. So that's not good. It's
so they should actually have learned something from gravity.
yeah,
Hoard some
but
money on the balance
but
sheet.
I mean they never really got to that stage, to be honest. Like it wasn't a company churning out money yet. They had only just started this whole strategy, and I guess it just they didn't survive long enough to see if it worked. So it's a tough business. That's there's no question about that.
Yeah.
All right. Let's see here. Do you have any thoughts on smaller Danish IT companies, stuff like CBrain, Netcompany, Data Process?
No, I don't follow them and I actually don't know a lot about them. As some of them I think is serving the public sector,
Yeah.
um, and um, and that's more about contracts, large contracts, and stuff like that. And I feel that we understand. Business to business and consumer related a little bit better. It's easier to understand what drives a business, and yeah, and then I think they're too small also for us to invest in. The companies that we invest in are typically quite a bit larger than the companies found on the Danish Stock Exchange. So
Yeah.
so they come with a lot of volatility because of their size, and yeah, so not much knowledge about them.
All right. Yeah, I kind of feel the same way. It's not companies that I really follow closely. I haven't seen anything from them that really like makes me think, wow, I got to get something of that. So it's they're just obviously we get exposed to them because they're Danish and we are Danish, but I've never really
We,
had the
we
time
use
to.
NemID, right?
Yeah, and so we all right. Uh, Let's see here. How do you see hims and hers adding GLP-1 to the inventory and maybe expanding to other countries?
Yeah. Yeah. So this was a great news from hims and hers, but it's also something they've been saying for a year that they'll do GLP-1 treatment, and they've had an obesity tier for a while, which has really been a success, where they just counsel people on dietary issues and stuff like that. And the announcement was that they are going to be selling both compound products, and then the original products from Novo and Eli Lilly. And compound products are products that are mixed. So it's the term is really about the pharmacist who stands in the back room and mixes some medications for the patient. So when he does that, it's not something that the FDA can approve in advance. It's not a product, but it's something that is mixed, and that's compound medicine. And then there is a law that when medications are in short supply from the manufacturers, then there are some compound medicine producers that are allowed to step in and deliver that product. And that's what's happening now. So HIMSS says they found a good supplier that can supply, and that is approved of the FDA to be a supplier of compound medicine. And they say that they suspect it'll be a year before Eli Lilly and Novo Nordisk can fill the demand. And it's going to be interesting because demand is also elastic. So once you get these compound products, which can be sold at a cheaper price, then you might increase demand, the overall demand, because more people get the product and get to know the product and get the opportunity. So if demand was here for something that was very expensive, then demand will be here. And I think there'll be some funny political discussions when Novo Nordisk kind of come back and say, okay, we can fulfill this demand. And then there'll be some people here that are used to getting the compound product. And is that demand, or is it artificial demand because it's too cheap? And what will the elected people say when their voters are not able to get treatment for obesity, which is really dangerous for people, and it's also a societal problem in the States. So I think there'll be some issues, and then I guess governments could say we subsidize the products for Novo and Eli Lilly, and then they don't have a problem. I don't know what's going to happen. For hims and hers, it's just a massive marketing campaign that they get for free. If you see their customer acquisitions cost now, they'll probably be negative or something like that. They don't need to do anything. They just need to open the doors and say we are open, and then people will just find them. So it's marketing is one of the is the largest cost line on hims and hers reports. So it's good. And they'll be selling the original products as well. So once things stabilize, they'll have the benefits still on, and they'll be able to cross-sell people who get obesity treatment. Many of them has diabetes or hypertension or depression, or so there'll be a lot of cross-selling. So it's just phenomenal for hims and hers, and it was darn cheap before this announcement. So it's just a really good investment opportunity.
I think you're really right about the whole sort of marketing angle. They're not looking to make money on this. This simply to, grab onto something that's, very much in demand right now, super popular and very well discussed, and then onboard as many customers as possible and get them through the hims and hers loop for the first time, and then suddenly some of them, stay and that's the mission, right? So potentially, I guess this loophole could really be a great tool for hims and hers and services like them in the future, or anything else that may end up being like this.
Yeah, extremely. They'll be like the Robin Hood of the medicine
Yeah.
industry. Yeah.
Okay. So Henrik asks, why has Broadcom seen a downwards trend over the last few weeks when Nvidia continues rising? Should I just close my eyes and wait for their reporting on June 12th?
Yeah, special hi to Henrik from me because, yeah, who's Henrik?
Yeah, Henrik is my dad. So I got him to invest in Broadcom last year, and I think he's a big fan of it, but a little bit worried right now that it's been stumbling a little bit. Do you have
Yeah,
some words of wisdom for him?
no, I think Broadcom has had a meteoric rise in share price. I'll just find the graph here, and if we zoom out a bit, then in 20 during Corona it was in 188, and now it's in 1,400. So it's just up a lot, and the revenue is not growing that fast. I think it's growing 10% or something like that. So I think there is a limit to just how quickly it can appreciate its share price. But I really think they're in a good spot. They are connect. They are one of the leaders in connectivity, getting data around in the data centers and getting data to and from the data centers, um, and that's going to be something that's in demand. And what I hear from their integration of VMware, they're doing a really good job. They are vertically integrating across hardware and software, and they are raising prices. And so it just seems like a really good stock for the future. And the things coming out of Ethernet is also really good. We saw Um, NVIDIA starting to enable Ethernet also. NVIDIA really wanted to use InfiniBand inside the data centers, but data has to get to and from the data centers, and that will be Ethernet. And Ethernet seems to a lot of companies wants to cooperate on Ethernet, probably also not to let NVIDIA be too powerful. So yeah, so I think they're in a good spot, and it's a good investment. It's a profitable company. They have a lot of good things coming. So that's kind of my take. What's your take, Jesper?
Yeah, I mean it's one of the companies I follow most closely, and there really hasn't been anything in recent reports or commentary or anything to show anything else than really good positive momentum. Numbers are great, forecasts are great, and I think their CEO Hock Tan is simply he's a master of everything, and he's really, really, really strong with acquisitions. There's a long history of successful acquisitions in Broadcom's history, and I think VMware was a great one, and I'm sure it'll be a great success once it's fully integrated. And Broadcom did rise on the day of Nvidia's earnings, and then just have been going down a little bit since. But I think Nvidia showing health and strength is a good sign for Broadcom as well, because that shows that this AI data center boom simply isn't the demand for that isn't over. And so there's really nothing now that says that Broadcom should be in any kind of worrisome territory. I think, yeah, it's very likely that's simply, taking a little bit off the top and calming down after such a great rise to the top.
Yeah,
Um,
another thing, a thing that I really I that made an impression on me on the NVIDIA's earnings call was there was this analyst who asked, um, why should data center build out? Why should
mm,
CSPs? Why should they buy the Hopper chip when in half a year they could get the Blackwell chip, which is 4x training performance and like 30x inference performance.
The next generation NVIDIA
Yeah,
chip,
yeah,
yeah.
exactly. And for almost the same price, so total cost of ownership or cost of processing power is extremely is way lower buying the next generation. And Jensen Huang answered that, well, if you're building something and you've only built like 5% of the capacity that you think you're going to, then it doesn't really matter if you put in some inventory that might be outdated a little bit before, because it's just going to be averaged out on the next 90% that you build out your data center on. So what made an impression on me was this number, that he really thinks that we're just 5% in the build out or something like that, and so much more is coming. Yeah,
Yeah.
and the other reason is that nobody wants to get behind. Everybody wants to be ahead in this battle, because they want to win it. The price is just huge. But yeah, the 5% just says that it's a long way to go, and that'll be good for Broadcom, and that'll be good for
Yeah.
the entire chip ecosystem. So much more compute to be built out.
There's so much money to be made right now that you simply take what you can, and then the big players, the giant ones, the Amazons and the Microsofts, yeah, they might get ahead and get the Blackwell chip before anyone else, but I'm sure there's a lot of middle players that are very happy with just getting Hopper chips.
Yeah, exactly. That's the other reason, right? We heard Amazon delaying further build out. They're waiting
Yeah,
for the Hopper chip, and that's, I think you're spot on. It's because they know they get it from the beginning.
yeah.
Whereas as other smaller customers to Nvidia, they'll have to take what they can get.
Yeah, and regardless, it isn't as easy to upgrade a whole cloud data center as it is to, switch the graphics card in your gamer PC. So it's always going to be a gradual upgrade. There's going to be data centers full of Hopper chips and Blackwell chips, and then, over time they'll yeah, go up. Let's see here. We have a question from Lucas asking our thoughts on Tesla Robotaxis disrupting Uber's business model. How can Robotaxis disrupt Uber's business model? Is the question.
Yeah. So once you get a new technology, there is always the risk that it disrupts the old technology. And that's what we're seeing now with AI and software as a service. And I think a lot of businesses is up in the air now. We have AI as a new technology, and I think Uber's business will be up in the air as well. So if I should say what Uber has that secures their position, it's distribution. So right now, when I want to go somewhere, or maybe not me, but Matthias Bo, my podcast partner, who's traveling around the world. So when he gets off in an airport, he finds his Uber app, and then he calls an Uber. And then when he's going to the airport, so they have distribution. They have the customers. They have the service up and running, and it will take a lot for a Tesla fleet to persuade Matthias Bo to try the Tesla app instead. They'll have to be reliable, and they'll have to be everywhere, and that's a lot of investments and a lot of stuff. So I think Uber is way ahead on distribution
Yeah,
and login, but and then you can say, if Uber's business model is distribution and a good app that solves problem for customers, yeah, well then if Tesla using AI or something can come with a smarter way of solving the problem of having a taxi where you get off, then Uber will be threatened. But on the other hand, building a fleet of robotaxis, that's just a capex problem. You just need a lot of cash to buy a lot of cars, or to organize a lot of people that has a lot of cars.
Yeah. Yeah, I think you're right. I think in actuality, it'll probably balance things out quite a bit for Uber once robotaxis are here, because on one hand, obviously they're gonna find new competition from, let's say, Tesla directly, but at the same time, it's always been sort of the end thesis for Uber, right? Getting robotaxis themselves, and according to the latest Tesla report, the idea is not only to have, an in-house fleet. The idea is to have these Teslas, run and owned by individuals or organizations running their own fleets, and so Uber can buy a whole bunch of Teslas, and then
Yeah,
suddenly their margins go up. And
yeah,
obviously,
and
it's a nightmare
and
for Uber drivers, but not so
yeah,
much
yeah,
for
yeah,
Uber, the
yeah.
company.
Yeah, the disruption will be of Uber drivers and not of Uber,
Yeah,
because that's two different things. The business model of being a driver, that's a problem when you get a self-driving. That's spot on, Jesper. And I think another business that we should think here is delivery. We we
mm,
see in South Korea, we see Coupang Eats and Yogio and the Bua brothers business. They're going bananas. They're giving subscriptions and free delivery like crazy. So maybe they're positioning now. They're seeing this, that once you get drones, once you get unmanned delivery, then you have a totally different business, and then the one that has distribution then sort of just buys the robots and wins the prize
yeah.
of how the next generation supermarket is going to look like. It's not being people driving to the supermarket. It's being drones flying whatever you need home to where you are.
Yeah,
Yeah.
but regardless of it being taxi service or food delivery, you have a really good point about the sort of first mover advantage. Uber has the brand, and Uber is the app that's installed on everyone's phone already. People know what the service is, and so if Uber starts offering self-driving taxis as well, that's just the option they're going to choose because they already have it.
Yeah.
So. All right. We have Benjamin Christiansen asking if we have any thoughts on AppLovin.
Yeah. Yeah. Uh, yeah. Yeah. I love AppLovin because it's a stock that's going up, and they're just earning so much money. And I think every Unity investor is just trying to figure out what their secret sauce is.
Hmm.
And their secret sauce is called Axon 2. And it's so funny when you analyze AppLovin or you look into it, and they say we have this Axon 2, it's our AI sort of thing, and you try to figure out what is Axon 2 doing. I haven't got the faintest idea of what Axon 2 is doing,
Me
and
neither.
I don't think they're not very vocal about it, what their secret sauce is, but it's very measurable for their customers, for their advertisers, what they get when they use Axon 2. And everybody just wants to use Axon 2, and nobody wants to use whatever it is that Unity is trying to build or create. And it's so counterintuitive because Unity should have so much more data on people and on games. They should be able to create so much more value. But AppLovin, they just got it. And then AppLovin is they want to do a lot more. They want to do streaming, and they wanted to get into adjacent industries, and
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 self-publishing of games as well.
yeah, and you're just like, well, how can they do that? But again, you don't know what Axon is, so
Yeah.
so maybe Axon is just going to kick ass when they get into the streaming industry as well. But I don't know, but it's just I don't think you should fight when a company just seems to have something that really works.
Hmm.
The only thing that should make you worried is the share price, but here it is, AppLovin, but they're really also just crushing it, and it's not very expensive, the stock, because they keep raising the bottom line every quarter. So we like it, and we have a decent position because of that.
Yeah, yeah. It's funny because you know, back when Unity announced that they were going to acquire Iron Source, AppLovin really made this what was seemingly a sort of desperate move,
Yeah,
trying to come in from the side to acquire Unity or merge with Unity instead of merging with Iron Source. And from that point, like it really seemed like they saw the combination of Unity and Iron Source as a major threat to them, and then they just ended up beating their ass. Like it hasn't even been close. So it's
but that was before Axon 2,
that
right?
was before that was with Axon 1, which
Yeah,
because I made a whole write up on the situation and really wasn't a fan of like if AppLovin at the time had succeeded in on the bid on Unity and merged, I'm not sure I would still be invested because I really didn't like what I was seeing back then. And then now it's just whatever they did with that AI model, it's unbelievably successful. It
yeah,
really is.
yeah. It's
So
like when McDonald's sort of just. I think there are some of the flavors in McDonald's that are trade secrets that you don't know,
yeah,
and my kids, they're like, no, we're not going to Burger King because McDonald's is just it just tastes so much better,
it's
and
literally a secret sauce.
yeah, yeah,
Yeah.
it is. It's so funny.
Yeah.
And also it's about tech. I don't think if they had known this, I don't know if they had bid on Unity, if they knew what Axon, what success that I don't know, but I don't think they could probably tell themselves until they saw the results for
Yeah.
their advertisers. So yeah,
It's actually a little bit, sort of Black Mirror, like having a product based on AI that you perhaps don't even really understand yourself, and then you have no idea what to expect, right? That's uh, that's a little bit strange.
yeah,
Um,
yeah.
yeah, but there was one more point I wanted to share, but now I've forgotten it. So yeah, I guess let's just move on. We have Kim asking, "Hi Mads, what is your expectations for PMI and NDI in the latter part of 2024 regarding expected returns, and also what are your thoughts on ASML?" That's a
Yeah,
two-parter.
yeah. I Yeah, I think a lot of I think our performance in May was weaker than the Nasdaq, and our performance was also weaker than the Nasdaq in November. So typically the upticks start with the Max 7, and then the broad market comes along. And PMINDI is really a broad portfolio, and that gives you diversification. It gives you less risk, less corporate specific risk. But in May, it's been a disadvantage for PMI and the I because it's been Magnificent Seven that was really strong. We've seen SaaS being weak. A lot of the tech has been a little bit weak, and then we've our top picks in NewDeal Invest has performed really well. Carvana, Hims and Hers, Chewy, also C Limited. So PMI and the I was our weakest in May. But if it goes like it usually goes, then once the big tech has sort of had its ramp, then PMI and the I comes afterward. Then the market rotates toward that. So longer term, I would say that we've had a big downturn in tech, and a lot of the tech stocks are still way down from where they were in 2022. And now I know a lot of people say that no, in 2020 that 2020 was a bubble, but they also said that about Nifty 50, and Nifty 50 wasn't a bubble, but the sell-off after 1972 was just investors throwing great companies out of the bathtub. And I think a lot of our stocks is a similar story once we get further along. So I think that yeah, I love the stock or the fund long term. Naturally, I do. And I think it has a great potential. It's always hard when you ask about next half year, because it really depends on whether we get a recession where stocks are going down, then everything will be going down. But I think the broad potential of tech is really good. Also, now that we've had the downswing in the SaaS businesses, which enable us to increase positions in them. A company like Snowflake, I think it's a great investment here. It's been way too expensive, and maybe it's not very cheap right now, but it's definitely better. So yeah, I really have high hope for that, and I look forward to prove what our concept can do for our investors. We're doing a lot of rebalancing that will also help the performance of the fund
Yeah.
long term.
And
Yeah.
you know, PMINDI has been performing exceptionally well in the first 6 months of its lifeline or what's it called? Its life.
Yeah,
Yeah,
exactly. Yes, but I said that we underperformed the Nasdaq in those 2 periods, but we've overperformed the Nasdaq
yeah,
over the life cycle, and that's really what is happening. We underperform when the market is concentrating, and then we overperform and more than get up to speed.
yeah.
Yeah.
We actually have a question along those lines. It's another one from Sen asking or saying, as an actively managed fund with more assets under management, you can sell and take profit regularly when stocks rise and buy the dip when they fall. But what is your advice to private investors investing for less money? Is it better to just buy stocks and keep them long term?
Yeah, first, we're giving a webinar on Tuesday where I'm going to be talking about this concept. But when you're investing in an asset that fluctuates a lot, it's really good to have some cash on the side that you can rebalance towards. There is a guy called Claude Shannon, and he's the Einstein of computer industry. He was the guy who invented the concept that information could be classified as bits and bytes. He did his master's degree when he was 22, and he sort of termed what became the foundation of the computer industry, and he was one of the ones producing some of the first integrated circuits. He worked at Bell Labs with Kelly, who made the Kelly's criterion. So what I was getting at was that he had a thought experiment called the Shannon's demon. And the Shannon's demon is that if you have an asset that doesn't create any returns long term, but it fluctuates, and you have cash and you just rebalance toward that asset, then you actually create a return, and you can do that as investor as well. So stock markets, they call volatility risk. So they measure the volatility and then they call that risk. And if you're a short-term investor, then volatility is risk, because you might have to sell when something is down, and that's really bad for your geometric return. But if you're a long-term investor, then the volatility on the way doesn't really matter. And then you actually have the opportunity to sell in and out. So one of the ways you could do that is you have to think tax, but in Denmark, if you have a if you use PMI for instance, which will have a lot of volatility because it's purely tech stocks, so it'll go up and down along the way. But I'm pretty sure it will go up because tech is always outperforming over the long term, especially if you diversify it out. If you can actually take an advantage of that and rebalance towards money. So keep some money on the side, and that will decrease your volatility of your entire portfolio. But I think if you're trying to do what we're doing in PMINDI, where you have more than 100 stocks, and you rebalance that, it's a lot of work, and it's a lot of tax you have to pay, and you also, for you to do that, you need to understand the long-term risks of the companies, because you need to be a long-term investor in the companies in order to say that if the stock falls, it just means I'm buying because I have a sort of long-term view on this stock, and it's still there. So for instance, Snowflake that we have here, if your long-term thesis changes because of what happens here, and you constantly need to evaluate that, then you can't do it. Then you can't buy more if it falls, because that's not good. So you need to be a little bit ahead, and it's a long rant on that, but it's really hard. So I think if I should do that myself, I would do it just with cash and PMI and DI.
Yeah.
And then rebalance.
Yeah. The webinar that Mads referred to is in 2 days, and we have Hans Henrik Bloksgaard along Mads talking about. It's actually pension focused, so it's about what to do with your funds to secure a good future for yourself after you're
He's
done
a senior
working.
advisor, advising senior people when they get close to the pension age on how to make the most of their personal economy. An independent advisor. So
And
everybody over 30 years should probably listen.
Yeah, and I've just shared the link in the chat for anyone that's interested in sort of managing your money on your own.
Cool.
Yeah. I think we are through most of the questions for today. We have one left, which is a follow-up from last time on SAP, which really isn't either Mads's or mine strong suit, but we can give it a shot. What do you say, Mads, as the final question?
It's a hard one. Actually, I think I learned I more than doubled my knowledge on SAP when I listened to the UiPath earnings call. They're really they're cooperating with SAP. It's one of their big they're cooperating
partners.
with partners to help automate that, and that goes good along with what you said, Jesper, on SAP, that it's a legacy system, so it needs some automation.
Yeah, the questioner's point here is that what do you say here? The SAP recognized the importance of AI, so wouldn't they be positioned to really capitalize on AI? They could incrementally integrate AI solutions into their offerings. They have the customers and their trusts in their solutions. Could this not represent a significant growth opportunity for them in the AI domain?
Yeah, that's a really good question. So if you think about Salesforce as well, Salesforce say that AI is a huge opportunity for them, and they could take AI and incorporate it into their products, and then make some really kick-ass products out of that. But they could also be disrupted because a new company comes with a smarter, better, cheaper solution. I don't know, a company like Monday is they are building a something like Shopify, where Shopify you can build plugins for businesses. You have developers developing plugins for businesses on Shopify. You can do that on Monday as well. So you can build a smarter AI customer relation management system on Monday and deploy that to businesses. So Salesforce, like I said, new tech is in the air. We have a technical revolution now. So everybody is being put to the test. Are we able to develop products with the new technology and keep our place, or is somebody new going to make it smarter for us? And some companies really have a problem, like Splunk, that's made for legacy data storage. Whereas SentinelOne is building their Singularity data lake, which is a modern data lake for cloud usage, and so there'll be some technological disadvantages and maybe architectural disadvantages as well. Last time Jordan explained about technological debt, which can really be a problem in this transition. So it's hard, but then as an investor, if you take a company like Hims and Hers, for instance, I think they're way better positioned for AI than a company like Salesforce, because their business model is new. They're the most digitalized way of getting to a doctor, and all the conversations is on digital media in some way or form. So once you're able to make an AI, a large language model, an AI, just harvest all that data and then use it for the service, then that's going to really disrupt a lot of the legacy way of doing doctor advising. So and Chewy is another example of that. I won't go into that now, but it's really AI ready. So so just a lot is up in the air about that. And then I forgot to answer about ASML actually.
Oh yeah.
I think and I think they're in a really good spot right now. 2024 is just a sort of waiting year, and it's turned out that it's like that for all the chip all the suppliers of production equipment for the chip industry, and all the suppliers are reliant on China demand, just like ASML is right now. So China is a risk, but it's the same for all of them, and they have a leading technology that there'll be a lot of demand for, and the European Chip Act, the American Chip Act, all this stuff is really going to be good for ASML and the other chip equipment manufacturers.
Yeah.
So yeah.
Back to SAP. I think I closed out last time, sort of commenting on how crazy it would be if they actually managed to reinvent themselves from this AI wave, because it's now that the opportunity exists now because we are at this new technology sort of big jump. But like Ernest is commenting here, the thing with SAP and Oracle is that they have so many customers so tied into their systems.
Yeah.
If they keep them relevant with AI, it will be quite hard to dislodge them. And I think that's the risk if you're really betting on an old legacy operation sort of reinventing themselves completely with some new technology. You're just sort of going against all that they are and their DNA as well. Like it's just not in the management DNA to be this innovative force, and I think that
No.
makes it a lot less likely for it to happen.
Exactly, and it will probably not be in the shareholders' best interest as well. They've got a value company or a GAAP company, and they don't want them to invest and bet the company on something like that.
Yeah.
Yeah.
Final question, Mads, for tonight. It's a quick one,
Yeah.
but an interesting one. Will NewDeal invest invest in the biotech industry in the future?
Yeah, it's a good question. I think the next big technological revolution that will be biotechnology, and there are some interesting companies, and there are some cross sections. So if we start in the very techie part, then you have Cadence that bought a company that designs molecules. Cadence is an electronic design automation company that makes chips, that designs chips. The Blackwell is designed on Cadence software and hardware. So they're very good at designing complex systems, and molecules can be designed as that as well. You have the Google AlphaFold AI project. So molecules, proteins is they're made of amino acids which are put together in a long string, and the amino acids has electrical properties and stuff, and sort of, and that so once they leave where they're being produced in the cell, they fold in a way, and it's the three-dimensional structure and the charges, electric charges on the surface that gives them their functionality. So you can Google AlphaFold is trying to figure out how to predict how molecules are folding. So if you know a 3D structure gives them a molecule this function, then you could actually just design the amino acid sequence that will give that function, and that's what Cadence, the acquisition they did, is trying to build a company that can produce. So that's very techy, and it's definitely within NewDeal Invest, our investment
Strategy.
area. And then you go all the way to companies that are building medicine on AI, and that's probably not it's not where we have our strength and knowledge, but it's hard not to move a little bit down that path where it's more AI or AI infrastructure that is sort of the differentiating factor for the company. I think that would be dumb not to pursue a little bit, both because it's a new trend, it's something we know something about, and it's good diversification as well.
Yeah.
Yeah.
Yeah. I think it's a super interesting area, and
Yeah.
I mean it's actually a really interesting question because it's also one of the very few areas where we in NewDeal Invest could have sort of a home court advantage, because there's a whole lot of biotech innovation happening in Denmark, in Copenhagen right now. So that's we were asked earlier about if we follow local Danish tech companies, and we don't really, but perhaps we could follow local Danish biotech companies instead.
Yeah, I'm actually a friend of one of the founders of one of the Danish biotech companies, and that are using AI to predict 3D sort of surface.
Yeah.
Yeah. Yeah. So it's very interesting, and yeah, and we won't not look into it, but it's not our core competency.
Yeah. All right.
Competence.
I
Yeah.
think we'll end it for tonight. Thanks everyone for tuning in. We'll try to get
Yeah.
Simon by for next time and dive
Yes.
into Intel in particular, perhaps something in the chip industry related. But I hope you all had good fun. We did, surely. So
Yeah.
everyone
Definitely.
have a good
Yeah.
night. And do you have
Yeah.
anything you want to end on, Mads?
No, I just wanted to say that you might think Intel is such a boring company, but once you hear Simon tell about it, then it just gets so interesting. So yeah, do tune in
Yeah.
next time and hear about. I think it's one of the great and interesting investment possibilities of the time we're in right now. and it can be a flop, but it can also be something very big.
Yeah, we'll definitely
Yeah.
see if we can get him
Thanks
on.
for.
So bye everyone, have a good